Hi there. In this video, we will have a short discussion on what you mean by gap changes. In the context of IFRS 15, which is our point of discussion right now, IFRS 15 has a lot of differences as compared to the old IAS 18. The differences are in the differences in the accounting policies. So whenever, just understand one concept is that whenever there's a new standard that is coming into force, which is going to replace an old standard, it is only the mere changes in the accounting policy in respect of some transactions. In respect of some transaction, there is a change in the accounting policies. So, how to account for those changes in the accounting policy? Every standard has as something called transitional provisions. Transitional provision. This is a transition from one accounting standard to the another one. So similarly, IFRS 15 also have some transitional provision. So whenever you read any standard, any any standard, it has to have some transitional provisions, which means suppose you are accounting your transaction as per the old method till here, and you are applying a new accounting standard over here, then in such a case what you need to do here, what you need to do on this date, on this particular date, because you have already recorded these transactions based on the prior year or prior period accounting policies. So whenever we talk about any new changes, how to account for the erstwhile transactions and how to account for the forward looking transaction, that comes in the change in the accounting policies. Now why this is important? So whenever we talk about any new standard, as I've already told you, we talk about changes in the accounting policy and accounting those changes from retrospectively to all the accounts, it may be difficult. So that's why transition provisions comes into picture and explains how to account for the old transactions and the new transactions. So this is very important because this is going to form our base to understand the two approaches that is provided by the IFRS 15. The first one is the modified approach and the full contract approach. The second one is full contract approach. So just understand, whenever a new gap comes up, new standard comes up, it only have changes in the accounting policy, and it's the very general rule that the accounting policy has to be applied retrospectively. It's a general concept unless and until there is some transitional provisions being introduced. So this is the whole concept of transitional provisions.